Alright, so I'm starting the recording. I will pause it after the first session and we'll resume it again. Just remind me that if I miss it, when I do it, I'll narrate it so that you know that I've done it. Alright, so where we left off, I'll just make sure we recap this. Remember, you'll see this even in the Nattenberg book. There's 6 positions, long, short, underlying, long, short, calls and puts, total of 6 positions. We should understand the payoff profiles for all the, payoff profiles for all the 6 positions, as well as all the, we should understand what the synthetic equivalents are, and we should also understand, be clear about the payoff profiles and the profit profiles of the synthetic. Better to do the profit profiles because that will include the idea of the payoff profiles. So we should be clear about all those. Okay, so we've left you to study that a little bit by yourself. Most of it we have done. And all right, so we'll now go on to, then we had the discussion on option profit profiles. The margins are not working very well here. Let's leave it at 130. Then we had the discussion on covered calls, cash secured puts. Okay, and there's a discussion on Warren Buffett's use of cash secured puts with the condition that he won't put out any extra margin if the, if the asset price decreases, or the other way in which the value of the short option for Berkshire Hathaway could have increased, or the value of the people who sold it to Berkshire Hathaway could have increased is either when you sell a put, there are 2 ways you can lose money. If the underlying asset price decreases, or the eyeball levels increase. Okay, so remember that if you sell a put, that put could go up in value even if the underlying asset price does not decrease. If the eyeball levels increase, then the put can go up in value. Simple here. If you look at this, if I sell this underlying, if I sell the put option 2.69 here, and I sell the put when the parameters like this, and nothing else changes, the underlying does not reduce in value. Nothing else changes. It's just that the eyeball will change, and I'll increase this from 25 to, say, just make it extreme. Or even if I make it 30, or even if I make it 28, see what happens to the value of the put option, 269. Nothing else is changing. See, 3-point increase in the eyeball, very short-term option. The Vega is not that much, and yet you see that the value of the put option has gone up from 269 to 3.03. So that's another way for the put option to lose value, and for the seller of the put to lose money. That is, for the eyeball levels to go up. So Buffett's condition was, of course, he knew that this could happen if he sold the option. So Buffett's condition was that I will sell it to you, but I will not put up any mark-to-market losses if these losses actually occur on the option that I have sold short. So Buffett is able to do it because Buffett is a very big player, and everybody wants to deal with Buffett, so he can get away with it. He has high bargaining power. But ordinary people will not be able to get this kind of condition. Okay, so that's another tactic, cash secured puts. It's a way of earning income. Okay, so let's now deal with the idea of AFP in practice. let's try to understand a little bit about, we have understood the idea of synthetic equivalence, and let's try to understand this kind of classification which we have done in your, if you remember when we discussed this particular decision problem of deciding the buy-sell bias, the DP4 solutions, okay? When we had discussed this DP4 solutions, I've given you a fairly extensive here, DP4. This format that I had given you, okay, we had discussed with reference to this. We had several discussions. Now, the importance of understanding this kind of framework is that you understand the context in which we do this entire valuation work, okay? It's all the valuation work. You'll see many courses on valuation, chapters on valuation in books. You have to understand the context in which those discussions are occurring, and that context is sometimes not explained properly. People just go and discuss valuation, but you have to understand the context in which that is happening is the DP4. Okay, so it's the DP4, the decision problem number 4, which deals with whether or not in any market, whatever you're trading, when I'm trading, if I'm trading dollar-yen, what should be the first question I look at? One of the most important questions, now that I've already come into a question like I'm trading spot dollar-yen, so spot dollar-yen. So obviously one of the first questions you'll have is, should I be a buyer or a seller in this market? Okay, so that is the context in which the whole discussion of valuation arises, and all these valuation models that you've done, I gave you a background, I gave you an understanding that all these models are fundamentally the same. Okay, they take the expected value of the return, the general formula we discussed, the expected value of the return, and you discount the expected value which will occur in the future period. You discount it to the present period and you will get the present value. So the important thing to understand is two things: that one, you have discussions of value. In most of the finance textbooks you will find that a disproportionate amount of time is devoted to this question, and it's really devoted to the fair value models, and all of your fundamental analysis is over here. So there are two important things to understand. One is that it's happening in the context of this buy-sell decision, and the other important thing is that I think we had a brief discussion on this, that there are two broad approaches to this, which you'll find not normally discussed, that this problem that you have, the buy-sell problem, that there is another way to solve the buy-sell problem, and that is by using technical analysis. Okay, so TA is technical analysis. Not explained it here, but we can maybe write it down. TA is technical analysis. So the point is here that maybe we should just write it here so that we don't take up too much space. This, we can merge this, centralize this, and say that TA technical analysis. So we had very little time to cover here, except for we spent very little time covering TA and technical analysis, but except for ideas, it's very small actually. We have to increase the row width here. Okay, so you understand that TA implies technical analysis. Okay, it should be implies, it should be just TA equals technical analysis. Bigger. Okay. All right. So this is what TA is. So the important thing to understand is that this entire discussion of valuation is not, strictly speaking, necessary. That there are certain people who actually solve this buy-sell problem without any reference to valuation. Okay, we had a brief discussion on this, and they use something which is a approach which is value agnostic, which means it doesn't really know about value and doesn't care about knowing about value. It's not important to them. So it's value agnostic. So this TA approach. So this is also a legitimate approach which allows you to completely solve this buy-sell decision problem without any reference to what is called fair value here. Okay. We should even make this actually a little bit clearer. Make it fair value. So whenever we discuss valuation, our value in finance, we are actually talking about what we call fair value, which straight away tells you that this is actually generally a very subjective approach. I think we'll have to put 2 over here. Yeah, because the first one it takes as the indication that you're entering a string. The first, comma here, single quotation, and it takes as an indication that you're entering a string for text. And so it doesn't show that first comma here. Okay, all right, so this is what it is. So fair value versus price. Put this fair value in brackets, fair value. And there is no reason to refer to it. And you have some idea of this. We gave you a basic idea of the trend analysis approach, which is you look at highs, okay, successive lower highs, then successive lower lows, and you can see how this market is trending down. So you do this trend analysis where you're just looking at the price movement, and based on that, if you're a momentum trader, you would go short here, and you would put a stop over here, all right? And if you're a mean reversion trader, maybe you will look at a slightly longer term approach, and you would try to maybe wait for a reversal, okay? And maybe you'd look at this longer term uptrend and wait for some kind of reversal here, and then go long, or then you'll go long the dollar. So this is showing you that you can actually solve the decision to buy or to sell without any reference to or any discussion of the fair value of the underlying asset. So this is the important thing here, is to understand that you can use technical analysis to legitimately solve this problem without any reference to fair value. Now, having said that, that's one important thing to understand. Now we come back to value, and we are actually now, this we had already discussed briefly before, but I'm recapping it because it's a very important understanding which you will not get in most other places, because it's not discussed like this, the problem. So it's important to be aware of this. Now, within the, if you decide to be in this camp, if you decide that TA is not good enough for you, and you decide to be in this camp, as we said, there are various approaches even within this camp. So there is the forecast-based valuation approach, okay, FPV, we have clarified here. FPV is, and we don't need a implied here, it's actually what it is, forecast-based valuation. Right? This you're already familiar with. Everything that you've done, your bond growth model, project NPV, bond valuation, everything, forecast-based valuation, because it depends crucially on the return forecasts in the numerator of the period-wise values that you compute for the future, and then you discount them. But here there's another approach, which is AFV. AFV is arbitrage-free valuation. Have we clarified that anywhere? Let me just, but anyway, well, I'll put this here. We know that AFV is, let's clarify this here. So this discussion we are having, which is, you already have a, so here the arbitrage means, AFV is arbitrage-free valuation. And here arbitrage means what we have referred to as CRA. Okay, CRA means classical riskless arbitrage. So when we say arbitrage, we are not using the word arbitrage in a casual way in which it has been used in the financial markets. We had some discussions of that. We are actually referring to real CRA. Okay, so this is the arbitrage revaluation approach, which is essentially, what is it? It is another approach to arriving at fair values. Okay, one approach to arriving at fair values is to look at, if we take a stock like, say, Microsoft. As you know, let's look at Facebook. There's a big antitrust suit that was filed against Facebook. Not much decline in the stock, actually, because I guess the market does not expect much to happen eventually out of that stock antitrust suit. So they're actually talking about, many of the US states have filed a suit against Facebook, saying that it is engaging in anti-competitive behavior, abusing its dominant power. And so anyway, so let's look at Facebook. So you might actually conclude, the approach to fair value here is, one approach to fair value is to basically forecast the future earnings of Facebook. And some of you might say that, okay, because of this antitrust lawsuit, where they're saying that many of the acquisitions that Facebook did, like WhatsApp, Instagram, etc., they are actually buying up their competitors, and they're reducing competition. So those acquisitions will not be allowed to go through. So they will be broken up. And so Facebook's earnings potential will go down, and eventually you might forecast the earnings, and you may say that, okay, based on my analysis, I think that Facebook is only going to be worth not 280 or so that it is worth now. I think the fair value of Facebook, based on my future earnings projections, is probably 160. All right, so that's one way of arriving at the fair value of Facebook. But the other way of arriving at fair values is using what we call arbitrage-free valuation. This is the valuation technique that we haven't yet learned. So let's learn a little bit about that. It's an important approach to valuation. And within that, we will see there are two approaches. So let's understand what arbitrage-free valuation is as a valuation technique. Here's the so here we make use of the synthetic position, the synthetic equivalent. And so you've seen this synthetic equivalence here. Okay, we'll try to get the text. Look at the synthetic equivalent. Yeah. Synthetic equivalence and classical riskless arbitrage, this is the part that we have done. Now, you already know what the synthetic equivalent is, right? We have defined it here. Okay. So what you do in classical riskless arbitrage is that, let's look at let's try to copy this part here so we don't have to write this anytime once again. Okay. So you already have a flavor of arbitrage-free valuation, but I'll just make sure that we understand the correct use of the term. So we'll recap this a little bit, right? That synthetic equivalence in arbitrage, classical riskless arbitrage here. Okay, so arbitrage-free valuation, let's put it this way. AFV is basically, let's put this, this is the term that is used in the world of finance. So you have to be familiar with this term, arbitrage-free valuation. This is, again, as we say, a term of art in the financial market, in the financial sector. So if anybody in the financial market says arbitrage-free valuation, you should understand exactly what they mean. And this is what they mean. They mean basically, this is used to refers to both a a process of arriving at a fair value estimate for any asset. Okay, so we can call it a base asset, because in every market we have a base asset and a terms asset, but here we are talking about, so for instance here, the base asset is the common share of Facebook, equity share, one equity share of Facebook. Okay, or the base asset is equity shares and the unit is one share, and the terms asset is US dollars. So in this market, you have two assets, Facebook common shares and US dollars, and you're exchanging one for the other. And right now the exchange rate is that one share of Facebook is worth around $280 roughly, 280 US dollars. So this is the base asset in this case would be the shares of Facebook, because that is what is being traded. So what's here? So the AFV refers the term AFV. I'm not going to say this long expression around every time. I'm just going to say AFV. And AFV can refer to both a process of arriving at a fair value estimate for any base asset. Okay. Or it can also refer to the particular use the same word here, process. After using the process referred to in one above. Okay. So it can refer to two things. How to use the word AFV. It can either refer to the process of arriving at a fair value, like for instance here, when you do your project NPV, what is the process that you use to arrive at the fair value of the project? And then you deduct the cost of the project, the C0 term. The way you derive the fair value of the project is to project the future returns from the project that will be realized in the future years. You will put them in each of the time periods in the future, and then you will use an appropriate discount rate like the cost of capital, like a WACC or something, and you will discount those future returns. We call them cash flows, but I prefer to use a general term returns, and you make those projections, then you discount each of them to the present value, then you add up all the present values of these terms, and then you end up with a present value for the project, and then you deduct the cash flow, the cost of the project, C0, and then you are left with the NPV of the project. So that's the process by which you arrive at this fair value. So that's what we are referring to here. Similarly, AFV would refer to the process of arriving at a fair value, okay? Or it could refer to the particular fair value estimate. Particular, by particular I mean that a specific fair value estimate. Like for instance, I may do an earnings forecast analysis for Facebook. I may project its earnings for the next 20 years, and I may discount those earnings, and I may come up with a fair value estimate. of Facebook, which says that the fair value of Facebook is only $160, and at this price, Facebook is significantly overpriced relative to my estimate of fair value. So that's also a process. Okay, so it can either refer to the process, the term, or it can refer to the particular fair value estimate, okay, that's being arrived at. So what we say here is that in this case, if we are referring to the 2, okay, in the case of 2, right, but referring to 2, when we are referring to the fair value estimate, okay, AFV is what the always remember to make the distinction between the market price and the fair value. Okay, so like when I was making a presentation, sometimes people are not clear about this, that some of the faculty members were actually, I was making a presentation on a markets topic actually, and some of the faculty members were actually not clear about the definition between fair value and market price. Not that they don't understand, but sometimes there's a communication problem. Some people thought that there's some subjectivity by which the investors arrive at the market price, and therefore, the market price is also subjective. But what I meant is that, remember that the market price is always objective, because we're not talking about how investors have arrived at this market price of 280. We are talking only about what is the market price. Okay, so the market price around 280 right now. There is no dispute about this. You can check it on the Yahoo Finance webpage or on your TWS, and there is no confusion, and everybody will see the same market price. And therefore, this is objective. So remember always the distinction between the market price and a fair value estimate. A fair value estimate in general is subjective, because different people will have different estimates when you're looking at these types of valuations. Any project NPV analysis is always going to be subjective. Any stock valuation is always going to be subjective. When you're acquiring companies, you will have a subjective assessment, okay? So when you have a Vodafone Idea merger, for instance, when one of the companies is valuing the other company, that value, the fair value estimate, is necessarily subjective, because it's based on forecasts of future returns, which nobody knows if they're correct or not. Okay, and different people will have different values. So therefore, values are generally subjective, except for when you have real fair value, real AFV, when it's not subjective. We'll come to that. Okay, so there's always, in general, understand the difference between AFV and the market price. So in this case, when we are referring to AFV as in 2, that is a particular fair value estimate, arrived at by using a process of arbitrage-free valuation. AFV is what the market price should be at in order to prevent any opportunity for earning, any opportunity to anyone, okay, to make it explicit, to anyone, for earning a risk less. Now, normally we don't like risk less like this. When we write riskless profit, we are only talking about we don't have time to go into the classification of risks, but in your next course, when we do risk management, corporate treasury risk management, we will learn about the different types of risk. But one of the classifications is between market risks and other risks like credit risk, operational risk, etc. So when we say riskless profit, we are only talking about riskless means without risk, but when we say riskless here, we are talking about, what I'm clarifying here in the brackets is that the expression riskless here is only referring to a situation where it is devoid of market risk only. It does not necessarily mean that there is no credit risk or anything like that. Riskless means market riskless, okay? Devoid of market risk. To earning a riskless profit, comma, by executing a CRA strategy. Okay. So if you remember, if we have a CRA strategy, what is a CRA strategy? We can recap it here. In this arbitrage, we will again clarify that we are referring to classical riskless arbitrage, or CRA, by executing a CRA strategy. What is a CRA strategy? We can put that in brackets here. This is making sure that we understand what a CRA strategy is. We'll put the whole thing in brackets. We'll italicize it. We can keep this as a way of recalling the topic. And we'll say a CRA strategy is put this here as a part of the recap. And we will now refer to a CRA strategy as this. Okay. And this B, and as a full B, and we'll just put this whole thing in italics so that we understand that this thing is a explanation for this, okay? And that if you remember, if you can easily understand what a CRA strategy is, you don't really need to read all this, but this is basically what it is, okay? Remember, a CRA strategy is always going to be very simple. You will look at the market price of something, any particular asset, okay? You look at the market price. It's better now to look at something which we will go into very soon. Let's look at a very important foreign exchange, what is called a cross rate. Okay, so how many Japanese yen per unit of euro? Okay, this is the European Union currency, euro, and against the Japanese yen. So here the base asset is euros, and the unit is €1, and the terms asset is Japanese yen. So the question is how many Japanese yen per €1, and the value of that is, this is the market price, and the market price of the euro as the base asset, well, that keeps fluctuating. At one point of time it was around 90 yen, then it went to 150 yen, and now it is back to around maybe this looks like 128 or something like that, roughly about 128 yen per €1. Okay, so the question then is going to be that in a case of a CRA strategy, what is it going to be? It's going to be looking at the fair value, looking at the market price of this. So you look at this market, we're just giving the example of this as a just to understand the concept, but the logic will be the same for any market, any asset class. So you'll look at how would you execute a CRA strategy? You would look at the market price of euro yen. We call this euro yen. And so you say that, okay, you can see market price around about 128. And then you would also compute a, you would ask yourself this question, CRA strategy. You would ask yourself this question, can I think of a synthetic equivalent for this particular market, for this asset? Can I think of a synthetic equivalent for the euro yen? And then I'm going to, if I can, then fine. Then only then can I compute then can I execute a CRA strategy. If there is no synthetic equivalent, there's nothing you can do. Okay, so that's why I've said here that synthetic equivalents are crucial to understanding and executing arbitrage strategies. So without synthetic equivalent, there is no arbitrage. And every time I use the word arbitrage, you have to understand I'm referring to CRA. I'm not referring to the various other types, various other ways in which the market uses the word arbitrage, which are not proper uses of this word. So we are clarifying every time CRA. So without synthetic equivalents, there is no arbitrage. There's no CRA possible. So therefore, when you're talking about a CRA strategy, what is it going to be? Basically, what are the steps for any set of positions in any market instrument combination? Okay, this is the position, okay, or the portfolio of positions. Okay. And the market price is known. So find out what is the market price, and then find out what is the synthetic equivalent, the cost of the synthetic equivalent. If the market price of the synthetic equivalent is greater than the market price of the actual position, so you find out what the synthetic equivalent is, what is the market price of that, and then accordingly, whatever the cost of the synthetic equivalent is, you will compare it to the market price, and you will do this kind of exercise. Okay, so if the market price of the synthetic equivalent is higher, then you will sell this and buy this, buy the B and sell the SE, and if the other this other case is true, then you will do the reverse. Okay. And so just as an example, if you go back to the exercise we did a few days ago, that you have looked at this. Okay, so if you're looking at a long put, you're looking at a long put price, you look at a put price and you see the price of the put is 3.032, and you want to find out if there is any arbitrage opportunity here. What you do is 3.032, you look at so you say, okay, this position is a long put, then according to the theory that I learned, what is the synthetic equivalent of the long put? So I could either buy or sell the long put, and on the other side, if I'm doing a CRA strategy, I would have to, if I buy the long put, if I go long the put, then I should go short the synthetic put. Okay, so the synthetic equivalent of the long put position is this, which is short underlying plus long call. So I would find out how much it would cost me to buy the call and go short the underlying. Okay, so total cost, including the interest cost, I would find out what is the cost of putting on this position versus what is the cost of putting on this position. So this is the original position, and this is what I'm referring to as P. Okay, and then here this is the SE, which is the synthetic equivalent. So I would like to, so the way I execute an arbitrage, a CRA strategy, is I look at the price of the put, I put up the price of the call, I look at the market price of the call, the market price of the put, and I look at the synthetic, the short underlying position, how much it would cost me to go short the underlying. And so I know that this is the position and this is the synthetic equivalent. And then I look at the two prices for the two components. And if this is higher, I sell this and buy this. If this is lower, I buy this and I sell this. Okay, so that's the CRA strategy. So the point of this is entire discussion, most of it is a recap actually, but this is a very important concept. So it's important you understand exactly how the terms are used. So it's either a process or a fair value, and here I'm referring to the AFV, the fair value, which is the number 2. Okay, is basically the fair value is what the market price should be at in order to prevent any opportunity to anyone for earning a riskless profit by executing a CRA strategy. Okay, so when we say what is the arbitrage free valuation for euro yen, okay, so if the market price is 128 and you do a synthetic equivalent analysis and you come out with the cost of the synthetic equivalent maybe is 125, okay, maybe the cost of the synthetic equivalent is 125, or let's say 120, let's to be clear, to make the difference very clear cut and stark. So let's say you do an AFV analysis of, you do the cost of the synthetic equivalent of the long euro yen position. So if you go long euro yen in the direct euro yen market, it will cost you 128 yen per euros. But then you do an analysis of the synthetic equivalent for this market, and you find that you can actually, using the synthetic equivalents, you can actually go long euro yen, not at 128, but at 120. Okay, so in this case, we say that the AFV for euro yen is 120. Okay, so you can understand why I've written this. So when we say, how are we using the term AFV? So we are using it in the second sense, not to talk about the process, but to talk about the particular fair value estimate. What is the process? The process is here. Basically, this what is the cost of find out the cost of executing the cost of putting on the synthetic equivalent position. Okay, and that's your fair value. So here we're talking about the fair value estimate. Okay, and it's basically this fair value estimate after using the process given above. Okay, which is basically that this particular fair value estimate will be. Let's clarify this even more. So that there is no confusion, is essentially the cost of putting on the, let me not write it once again. What is the fair value estimate? The fair value estimate is basically the cost of putting on the synthetic equivalent position. Okay, so if we say here that, let's say that both bids and offers are 128, so the cost of either selling euro yen or going short euro yen or going long euro yen is 128. Now you do a synthetic equivalent analysis of this market, and you find that there is actually a way to go long euro yen, not at 128, but at 120, okay, using the synthetic equivalent, which means the synthetic equivalent of the long euro yen position. Just like here we looked at synthetic equivalents of, you know, short underlying, long put, long call, short call, various positions. We look at various positions and then we try to think about what is the synthetic equivalent of that. So similarly, we look at a long euro yen position and we try to find out if there is a synthetic equivalent of that. And in this case, let's assume that we did this analysis and we found that using the synthetic equivalent, one can go long euro yen at a cost of 120 instead of 128, which is the market price, the 128. So basically, we say here, therefore, that this is this, that when we talk about the second part, when we say that AFV, what is AFV? When we use the term AFV, arbitrage free valuation, in the second sense, the particular fair value estimate that's been arrived at using the arbitrage free valuation process, which is basically this, the particular fair value estimate that you arrive at by using the AFV process is nothing but the cost of putting on the cost of, you don't have to use this anymore. is the cost of the synthetic equivalent position. Okay, so as I said here in this example, you find that using synthetic equivalents, you can create a long euro-yen position but at a cost of 120. Okay, and so essentially that's therefore the fair value estimate. Okay, so when we say this, we're talking about the second one. What are we referring to? It's essentially the cost of putting on the synthetic equivalent position. So the arbitrage-free valuation of a particular base asset, okay, any base asset. In this case, it is any base asset in any market. Okay, should not be just in any market. Always when we say market, we should talk about market instrument combination, because markets do not make any sense unless you talk about market instrument combination. Okay, so here it is actually euro-yen spot. The instrument is spot and the market is euro-yen. Okay, so you have to always talk in terms of euro-yen spot, because you could also be talking about euro-yen options, euro-yen forwards, euro-yen swaps, euro-yen futures. We could be talking about all kinds of different instruments. You have to be clear about what instrument and market you're referring to when you're talking about the base asset. So for any base asset in any market instrument combination, and I'm clarifying that once again because it never makes any sense to talk about a market without talking about the instrument also, because any market price is always the price of some instrument using which that market is being traded. So therefore, you have to always talk about market instruments combination. So in a particular fair value estimate is nothing but the cost of putting on the synthetic equivalent position. Okay, so therefore, what we say is that, just to repeat the long discussion, just to make sure you understand how the words AFV are used. So here we say AFV, the second sense, if using synthetic equivalents, we can create a euro-yen long position at a cost of 120, and we observe that the market price is 128. So here we say, therefore, is the particular fair value estimate we arrived at in the case of the euro-yen. Okay, we say that the fair value estimate for the euro-yen, okay, is the cost of putting on the synthetic equivalent position of the long euro-yen, and that is, say, 120 in this case. Okay, so therefore we say that the AFV is 120. And what is 120? Essentially 120 is, here the AFV is what the market price should be at in order to prevent any opportunity for earning a riskless profit. Okay, so what the market price should be. So the second sense of using AFV to refer to a particular fair value is what the market price should be to prevent any opportunity for earning a riskless profit. To understand why this language, because when you look at the language, it can get a little confusing. That's why I'm giving you the example. Okay, so by executing CRS strategy, we'll leave it here. I'll give the example over here. Okay, so example. Okay, so let's look at the example. Market price of euro-yen spot. Okay, market price of long euro-yen spot position, okay, or cost of going long euro-yen spot position. This is our long euro-yen spot position. Okay, let's say the market price here is 128. Okay, after doing AFV analysis, creating a let's call this the direct, which means the direct long euro yen spot position of market price, which means I go to the euro yen market and I directly look at, maybe at this point it is useful to talk about FX quotes from using maybe let's look at FX quotes from pages where we can see everything together. Let's see if we have something better. We will not get. Just trying to pull up some foreign exchange quotes where we can see some major market prices together. That's right. Okay, good. This is what I wanted actually. So let's look at, and since today is Thursday, we don't have to worry so much about this. Let me bring this here and show you what we mean. Let's try to increase the font size. Let's see what bigger here. Got it. And yeah, you can see now here we are so big. You can see it here. Okay, these are, we'll assume that last is equal to bid is equal to offer. We will assume that everything here is a choice price. Markets are right now closed actually because today is a Saturday. So what we mean to say here, very important that we understand all this correctly. Market price of long euro yen spot position is 128. I said, let me use the market price is actually given here. It's 125. Okay, so 125.90. We'll call it 126. Okay. 126. So we'll say 126. So market price, how do I get that? I go to a website like this and I find out what the price is. And so this, when I say the a market price of direct long euro yen position, okay, we are going to assume last price is equal to bid price is equal to offer price. So everything, these are all choice prices. Directly going to the euro yen market, there is a quote in the market for euro yen direct, and I find that this is 126. I'm going to take this as 126. So if I go directly and buy euro yen in the market, it'll cost me 126 yen per euro. All right. Now, after doing our AFP analysis, we find that the cost of creating a let me contrast the direct with the indirect. Okay. So here I'm saying direct, and therefore the cost of okay, so obviously when you're communicating with other people, you don't write indirectly like this. I am writing it like this because I want to sharply make a distinction between direct here and indirect here. So that's why I'm writing it like this, but this is not a lesson in English communication, so please do not write indirectly like this. This is only for our understanding. Okay, so we find that the cost of indirectly creating a long euro yen position, okay, using again, I'm going to try and avoid writing that word. Okay, figure. After doing AFP analysis, which is nothing but AFP analysis, is nothing but looking around to see if for this long euro yen spot position that we can take directly by paying 126 yen per euro, you ask yourself, is there anything in the market that allows me to create a long euro yen position using some other market instrument combinations and basically trying to construct a synthetic equivalent of the long euro yen position? And that's basically what the AFB analysis is. So you do that AFB analysis and you find, and we will have a discussion about this, we will figure out how to do this. Okay, but essentially we find that, let's finish the analysis here. Let's assume that we have finished the analysis. After doing an AFB analysis, we find the cost of indirectly creating a long euro-yen position using synthetic equivalence is equal to, let's say, 120. Okay, I'm just giving an example. Here is 126 and it's 120. Okay. So basically right now, okay, using the logic we already gave earlier, if you see this logic here, we gave this logic earlier. So right now, it's possible to avoid having to write all this. Execute a CRA strategy and earn a by, in this case, what am I going to do? Because in this case, we find that we go back to our logic here, the algorithm here. We find that the market price of the P, that is the position, okay, the position is 126, and the synthetic equivalent is, or the cost of creating the synthetic equivalent is, this actually should be clarified as cost, as in cost of creating the synthetic equivalent is okay. So here we find that the market price is 126, and after doing AFV analysis, let me just copy this here, save some space. I'm just going to put it here so you know where the hyperlink is. So we'll remove this and we'll get one line here. So we find that the direct euro-yen is 126, but the synthetic euro-yen long is 120. So right now it's possible to execute a strategy because the synthetic is cheaper than the actual or the direct. Okay, the indirect synthetic is cheaper at 120 than the direct position. So in this case, we sell in this case, we execute this. We buy at 120 and sell the P, okay, the direct P at 126, okay. And highlight. Direct is 126, indirect is 120. Okay, so we can execute a CRA strategy. We find the synthetic is cheaper, so we buy the one that is cheaper. We sell the one that is more expensive. We sell the euro-yen. Okay, so we sell the direct position at 126, and we buy the synthetic equivalent at 120. okay, and earn a riskless profit of 6 yen. Okay, we'll call this JPY. We'll give it the proper official name of 6 JPY. Actually, 6 yen. Okay. That is, we sell 1 euro at 126, and we buy 1 euro at 120. So we make the difference of 6 yen. The difference is only 6 yen per euro, but of course this profit, because it's a riskless profit, people are going to do this trade with a massive position size. People will try to do this for literally for billions of euros, as much as you can actually execute in the market. So this is a idea that you will find even when you read the Nattenberg book. You will find this idea that because there is no market risk, okay, devoid of market risk, these positions, these strategies, these trades are devoid of market risk, so people have no fear. They will do this for massive positions and pick up huge profits, and these are riskless profits. So, but the actual profit on a particular one unit may be very small, but that doesn't matter because you will do the position, you will do the trade for a massive number of units. Right. So this is the idea here that, so in this case what we do, so we can say, so therefore coming back to this long discussion, but making sure that you understand what we mean when we use this expression, that the use of the word AFV in the sense of 2, okay, the fair value estimate. In this case we say, so here we say that the AFV of is 120. Okay, so not very good formatting, but remove this, but we make it all 14 and all together. Right? So this is where we say that the AFV is 120. Okay, this is what we say. One and very common. Okay, so the AFV of this is this important statement. So let's put it. We'll put it in bold later on. Okay, if i.e. If the market price had been or is at 120, okay, then there will be no chance to make any profit. We'll just repeat this. What did we say? Okay, so we are talking about the use of the word AFV in the second sense to refer to a particular fair value estimate, okay, which is essentially the cost of putting on the synthetic equivalent position. And when referring to AFV is what the market price should be, we'll just copy this, okay, so that here I have, through all this example here, I have just illustrated this one sentence. That's all I've done. But to make sure, this is a very important understanding of the word AFV, of the expression AFV, and that's why I spent so much time explaining this whole exercise. So right now I'm just going to repeat it. If the market price is at 120, I'll just repeat the. I'm just saying in the sentence construction here. If the market price is at 120, then it will not present, and then I'm just going to, it will not present, yeah. So if the market price is at 120, it will not present any opportunity to anyone for earning a riskless profit by executing a CRA strategy, yeah, because if the market price is at 120 instead of 126, then the fair value, then the synthetic equivalent is 120 and the market price is also 120. So they are equal, okay? So therefore there is no opportunity to earn any profit. You cannot do either this or that. So therefore, this is why we say that the, so here we say that the AFV of the long Euro-yen spot position is 120, which means if the market price, now you can understand what it is that I'm saying here, that the AFV is what the market price should be at in order to prevent any opportunity to anyone for earning a riskless profit by executing a CRA strategy. So if we say that the AFV is 120, and the AFV is nothing but the cost of putting on the synthetic equivalent position, okay? The cost of indirectly creating a synthetic equivalent position, which is the AFV is just 120, okay? In the second sense. And if the market price can be set equal to this at 120, then there is no opportunity to execute a CRA strategy and earn a profit, okay? Is this clear to everyone so far? I had a long, actually I made this a very long discussion. Maybe I have spent more time on it than I needed to have. But I just wanted to make sure that everybody understands that this is a very important understanding of this kind of a technique, because this technique is a very different way. You notice why I have put this difference between FPV and AFV. This is a taxonomy, so it satisfies one of the important principles of taxonomy, okay? And it's very important to remember these things, because in the real world, you will find many people making these kinds of classifications without following these rules, okay? So for instance, if you have boys and girls, that means the boys cannot be girls and the girls cannot be boys, okay? If you have fruit and vegetables, that means the vegetables cannot be fruit and the fruit cannot be vegetables. So these are mutually exclusive, to use the language of set theory. The taxa or the categories that you use in any classification system, the categories should be mutually exclusive. So if I put this AFV and for FPV, that means that AFV is not forecast-based valuation, okay? And so what I have talked about, FX cross rates as an example, okay? You notice that I have, so these are, what is similar to these two? There is a distinction and then there is a similarity. There is a distinction because they are slightly different, okay? And that's why they are mutually exclusive. But they're also same because they are both fair value estimates. When you do a Gordon growth model for stocks, that's a fair value estimate. The stock value that you find out, that you estimate, that's a fair value estimate, okay? Project NPV, that's a fair value estimate. Similarly, what we just did on the Euro-Yen, okay, what we did essentially is, we said Euro versus Yen. Okay, how else can we create Euro-Yen? We can look at, well, let's look at this. Dollar versus Yen. And then let's look at Euro versus dollar. Here, can we cancel out the dollars? USD cancel out. And we are left with Euro and Yen. So it should be possible to create euro-yen position synthetically by combining these two markets, long here, short here, or vice versa. We do something, and then we create a synthetic euro-yen position. We can do that. So this is the kind of analysis that we do, and we find that we can do that, right? And so you'll notice here that this approach, so these are both fair value estimates, okay? Using this, you arrive at a fair value estimate and you compare it to the market price, which is, you saw us doing that here, okay? You saw us doing that over here. We looked at the market price, then we looked at the cost of the synthetic equivalent. So we are doing, and this is the fair value estimate actually, okay? And so therefore this is a fair value. These are both similar, but there's a difference here. You'll notice that in this, you'll see it more clearly when we actually give the example. But you'll find that when we do this AFV method, the reason I've made it a different subcategory distinct from FPV is because here we are always relying on forecasts. Why did I call it FPV? Why did I say that your Gordon growth model and your NPV fair valuation, these are all the same method because they all rely on forecasts of future returns. Here you will notice that we do not rely on forecasts, okay? It does not rely on forecasts. So the AFV does not rely on forecasts. So we can actually write this here. As a, now we are discussing the framework here. Refer framework. And what is the framework? And for add, we will just use this. So if we take this, we put it here. So if you launch this, I think Google is so smart that if you launch this, it should take you straight to that page. Although there are many sheets in this file, it will take you directly to that page, right? So you can see how smart Google is. I was just testing that, okay? So I'm just referring to that framework. Now, true AFV, okay? If we see true AFV, yes, Srishti, what is your question? Yeah, Srishti, you had a question? What happened? I'm not able to hear her actually. Do you have a question, Srishti? You raised your hand. Okay, I don't know, somehow I can't hear her. Okay, can anyone speak? I want to just test make sure that I can hear you guys.
Yes, sir.
Yes, sir.
Yes, sir.
Okay,
Yes, sir.
at least I can, so there's nothing wrong with my audio. So maybe
So
there's...
actually Shrishti is not audible to us also.
Okay, okay, fine. No problem. Okay, because she raised her hand, so that's okay, fine, no problem. There's no problem. Maybe she just accidentally raised her hand. Okay, so let's look at true AFV. So the statement I'm making with reference to this framework is, why have I created this? Very important for you to understand this framework because it will give you a contextual understanding of all the techniques that you use. What is TA? Okay, what is all this stuff that you did, because you will not find this kind of a classification of approaches anywhere. This is my own classification, and you'll understand why I have done it the way it is. Okay, you'll understand the difference between this and TA. In TA, we don't care about what is fair value. We just look at price and we analyze the price patterns. So that's important to understand, because you can solve the buy-sell problem without any reference to fair value. Okay, it's important to understand that. Now, whether or not you will actually believe in this is a different matter. Okay, some people may not actually believe in this, like your senior, I think Pratik Chugh is your senior. Pratik Chugh is somebody who believes in fundamental analysis, and so it's nothing wrong with that. And these are just people have different views. So he would actually never use only TA, or probably he wouldn't use TA at all. So this is important. So this classification, because he believes in fair value based, the philosophy behind this approach. But even within fair value, there is a classification, AFV versus FPV. And what is that? The true AFV is different from FPV, forecast based valuation, because true AFV does not rely on any forecasts. I'm sure that we have the right font size here. Yeah, it's different from FPV because it does not rely on any forecast. So that's why I made this classification. What is the difference between these two? The difference is that So the difference between these two is that in forecast-based valuation, whether you are using the Gordon growth model and forecasting the dividend growth rate, or you're doing project fair value and forecasting project cash flows, all these are forecast-based approaches, whereas in AFV, you will not need to refer true AFV, not this part, not the option pricing part. But in true AFV, you will not need to refer to any forecasts. All you will do is do this kind of analysis. Okay, the cost of euro yen, buying euro yen directly in the market for euro yen is 126, rounded off. Let me see if I can create a synthetic equivalent for the euro yen position. Is there a way to go long euro yen without touching the direct euro yen market? Can I do it by creating the synthetic equivalent of the euro yen long position using some other market instrument combinations? Instruments remain the same, everything is spot, but these are other market instrument combinations because they're referring to other markets. Let me look at the euro yen, euro versus US dollar. We should always refer to this as euro dollar FX. Don't forget the FX part. Okay, always refer to it as euro dollar FX. Euro dollar FX, let's look at that, and let's look at the dollar yen market. So two different markets, euro dollar FX and dollar yen. Can we cancel out the dollar in some way? And can we use these two markets to synthetically buy one, sell the other, etc.? So we'll do something. But can we create a synthetic equivalent long euro yen position by trading in these two markets without touching this market? So you notice that I'm not relying on any forecasts because I can see the market prices in these two market instrument combinations. I can see the market prices. Can I do something here to create a synthetic equivalent? And I'm not making any forecasts. I'm not relying on any forecasts, and I'm directly arriving at a fair value. So that's why this has been put in a different category from this. Okay, but actually we are only referring to this part. There's a reason why this subcategory is created here at the next level. I'll explain that. But first, we are only talking about true AFV, properly so-called. Okay, proper or true AFV. This is a sort of fake. This is a fake AFV. Okay, this we are not referring to. We are referring to true AFV, FX cross rates valuation, and it will be done in this manner. It will not rely on any forecast. It will just look at market prices. So that's why we say that this is a separate category here. It does not rely on any forecasts. And this is the important thing. So we had a long discussion, but it's very important to understand exactly how these terms are used. If we use the word arbitrage, because this is a very important technique in finance, okay? So using this technique of using synthetic equivalents to arrive at arbitrage-free valuations, okay? And you understand why exactly, what is the role of arbitrage-free valuation? Proper AFV. It is a way of arriving at fair value, which is a way of solving the buy-sell problem. Okay, remember that when you do fair value, it gives you a way to solve the buy-sell problem. You compare the fair value, which is this. This is the fair value. This is the market price. You compare the fair value to the market price, depending on which is greater. You buy one, sell the other, buy one, sell the other. So you automatically get a solution to the decision problem number 4, is whether I should buy the original position market price or I should sell the price, original position market price. Okay, whether I should sell the original position or buy the original position. That was our DP4. So the AFV method is a fair value estimate, gives you a fair value estimate, and allows you to solve this problem. Allows you to solve this problem of buy or sell. Okay, so therefore it belongs to this technique. Okay, so this is a long discussion, but it's important to understand that there is one way of solving this problem. So when you look at the euro yen, you may be confused as to whether I should buy or sell this thing. Well, there's no need to be confused. Just take 2 seconds, 2 minutes. All right, okay. So there's no so what is the utility of AFV? You look at euro yen, you're again confused. It's 126. Should I buy it, or is this going to go up, or is this going to go down? That means, should I buy it or should I sell it? There's no need to be confused. If there is a way to find a synthetic equivalent, you can do this true AFV analysis, and you find the synthetic equivalent is 120, and the market price is straight away. You go into this framework, compare fair value to price, and you find that the synthetic equivalent is 120 and the market price is 126. So this is cheaper. Buy the cheaper, sell the higher, the one more expensive. And therefore, the question of whether I should sell the market or buy the market is solved, because by comparing it to the fair value estimate, I have solved that problem. And how did I arrive at the fair value estimate? Using AFV, true AFV, which is the entire discussion that we had. So that's why we say, repeating, that the AFV of the long euro yen position is 120. If you set the market price equal to the AFV, there is no chance for, right now it's possible, yeah. Then you do that. If the market price is set to the AFV of 120, then it is not going to present any opportunity for earning a riskless profit, okay, by earning a CRA, by executing a CRA, because synthetic equivalent is 120, market price is also 120, so you can't make any profit. Okay, so that's the whole idea. So we'll continue with this discussion in the after 15 minutes. So we'll start at, maybe we'll give you a 15-minute break. So 11:02 right now. So we'll start at 11:17. So I'm going to keep this discussion open, so you guys should also keep it open. What I will do is I will pause the Okay, folks, so we're back in action. We are at 11:17. I have already resumed the recording. Okay, can everybody see the theoretical framework page? Now I'm going to the notes master spreadsheet. Everybody?
Yes, sir.
Yeah, okay, good, excellent. So we'll resume that. We have lost one person. This is like, we went from 33 to 32. It was like when the Pandavas were going up to heaven in the Mahabharata, one by one the brothers started falling off. In a similar manner, we are losing students as we go into the second session. One student has disappeared. Okay, so let's go. Let's continue with. Okay, so Siddharth asked this question about at the end of the previous class about why I have included option valuation models in the improperly called. Let's call it, using layman's language, fake AFV. This is true AFV. We can use this language here because this properly so-called and improperly so-called is taken from the English jurist John Austin, who you might remember when we discussed legal positivism in legal aspects of business. So we refer to John Austin. So these are terms from John Austin, so we don't need to, these are very, very long expressions. So we'll call it true AFV. True AFV, and we'll call it fake AFV. Okay, and or we can call it proper and improper, true AFV and fake AFV. Okay, so we'll come to this later on, but let's continue with our discussion. Later on in the same session, we'll come to this. And so the idea here is, of course, this is called fake AFV because it is actually not, arbitrage. It's not possible to execute the arbitrage and make sure that the synthetic equivalent price becomes equal to the market price is equal to the synthetic equivalent price. So we'll understand this. We'll understand this very soon. We'll put on these two terms, true AFV and fake AFV. And let's continue with our discussion here. Right. So this is our earlier example where we tried to, probably not a great example, but we tried to explain the idea of the synthetic equivalent is a set of positions using which you can recreate that original position, okay, without actually doing anything with the original position in the market for the original position. That is, when you see a cup of hot tea trading in a particular cafe at 105 rupees, you don't try to go to another cafe and see if they're selling another cup of hot tea with milk at 105 rupees. That would be the same, you don't really look for that. But really you look at synthetic equivalent, so you try to see the component parts. Can you buy the component parts and create this product at a cheaper price? Okay, so that's the idea of the synthetic equivalent. As I said, probably not a great example. Maybe you could think of a better example, but I wanted to give something that everybody could easily relate to. So that's why I gave you that example. Okay, so let's go back to where we ended the previous part of our session. Here. This is too far away. Okay. We are still in this topic of AFV in practice. What happens with AFV, how you use AFV to solve the problem of buy-sell, okay, that you've already seen. Right, so we say that therefore at this stage, if you set since the cost of the synthetic equivalent position of creating the synthetic equivalent position is 120 and the market price is 126, we say that the arbitrage free valuation for the arbitrage free value of the long euro yen position is actually 120. Because if the market price is set equal to the arbitrage free value, right, then it will not present any opportunity for earning a riskless profit by executing a CRA strategy. Okay, so again, just to explain once more, what is meant by arbitrage free? Let me see if I can copy it from somewhere so I don't have to write that. Yeah. So why the expression arbitrage free? Free of any free of, okay, means just got from price to rice. That is it, okay. I mean, it should be small it. That is it. When I say it, I'm referring to the market price. I want to make sure that you understand the language exactly. Why do we say arbitrage free? It's a short word, but we are using it to refer to something very specific, that we say that the arbitrage free value for the long euro-yen position is 120, which means if the market price is 120, here arbitrage free means that the market price, if set equal to the IFV, is free of or devoid of, okay? It is free of any arbitrage opportunities. It is devoid of any arbitrage opportunities. That is, if the market price does not present any opportunity to earn a riskless profit. That's what it means, okay? So arbitrage free means free of arbitrage opportunities, okay? Another way to, or we can write this another way. So I'm writing a lot on the same topic, which is just to explain this, so maybe I'm oversimplifying it. But it's important to make sure that everybody understands it. Arbitrage free means basically means free of, let's put it this way, CRA opportunities. Opportunity again is a big word, so I'm not going to write it. I'm just going to copy it. Free of CRA opportunities. That's it. Basically, that's what arbitrage free means. Okay. So by arbitrage free, we mean free of arbitrage opportunities, of CRA opportunities. Right? And always, because you guys are new in finance, you're learning these concepts for the first time. What you must do always is, when you are talking about arbitrage, okay, and especially about AFV, you must always remember that it is AFV is referring to CRA, and it is not referring to those other examples I gave you, like risk arbitrage StatArb, uncovered interest arbitrage, etc. All those examples where the market or the industry uses the word arbitrage in an improper way to refer to things that do not represent CRA. So every time you hear the word arbitrage, arbitrage-free valuation, all these ideas should be playing through your brain so that if you keep repeating these ideas, the connected ideas every time, then eventually you will be clear about these distinctions. What is arbitrage? What is really CRA? What is not CRA? And what does AFV mean, etc. So go through all these examples in your head when you read these things. Okay. So now you understand what arbitrage-free valuation is. Okay. Now let's understand one more example here. This is just the stuff that I copied from here. Arbitrage here means only free RA. The market prices that were not presenting opportunities. Yeah, so this is fine. This is a proper statement. This is a frame statement. It's different. True AFV does not rely on any forecasts. This is the important part, and that's why we put true AFV over here. Okay. So now let's look at. We are going to look at some other examples also of true AFV. But let's look at, since this module is called AFV in practice, let's call it AFV in practice. As in the first example that we're going to look at is, so now we've understood what we mean by AFV. Let's try to understand AFV in practice. Practice, or let's call it true AFV. FX cross rates. Do I have somewhere here, have I written about, yeah, AFV for FX cross rates plus dollars trades. Let's take this particular module, which I had planned to do after conversions and reversals. But since we are given this example, I want to do it right now. So let's do it this way. Put this as a subtopic, AFV for FX cross rates. And dollars trades. Now let's understand the difference. First, let's understand the terminology. Okay. Now here, one of the things that we use in India. Okay. So here we are now jumping across to foreign exchange markets. Okay. So we are jumping into. We were actually doing U.S. equity options. So we were in the asset class equities. Now we are jumping to the asset class foreign exchange. Now, this again shows you that the general principle, that the principles we are learning, these are all general principles, and you should be comfortable with this kind of practice, where we jump from one asset class to the other asset class. We jump across markets, we jump across instruments, because the principles we are studying are all general principles, which is another thing that is unique about the way that I'm teaching you finance, and it's distinct from how it is taught in many business schools, where it is taught according to one, usually with reference to spot instruments in equities and bonds, but it is not taught as general principles. But I don't think that's the right way to study. You should study according to general principles that can be extended to the maximum range of markets, asset classes, and instruments. Okay, so we are now jumping across to foreign exchange, and we are looking at certain applications of these general principles in foreign exchange. Let's understand the terms first. Double, comma. Yes, okay. So cross rates. Okay, let's talk about international conventions, and let's talk about India. Okay. Let's talk about international markets and India. Another reason you'll understand why you should study with reference to global markets. A subject like finance, marketing you will study with reference to India mainly because marketing is very location specific. You learn there are certain general principles, but very heavily context dependent. Therefore, but in finance it's very different because the theory is the same everywhere, and it is always better to learn from with the focus on international markets. Let's look at these terms: cross rates and dollar strengths. And we will use these terms in India as well. Just call it India. So Indian FX markets, okay, let's call it Indian FX markets. So if any of you like what I did, like my first job was at a foreign exchange trading room at American Express Bank in Bombay. So there I was in the Indian FX markets. Okay? So cross rates and dollar strengths. How do we define it in a different way? And language, let's get the language right. Cross rates, international FX markets, okay, or global spot FX. Okay, what you can see here, if you can see, for instance, I'll just give you FX market hours. I'm trying to get that. Rwanda is difficult to access from India because our Reserve Bank has a lot of restrictions, so you can't open a Rwanda account from India, but you can pretty much open it from every other place. What happened to that applet actually? I'm trying to find that applet, but well. Okay, you can't find that applet anymore, I guess. It's a very useful applet looking at different FX markets. But anyway, so international FX markets, okay. All the way from Wellington in New Zealand, where the sun first rises, all the way down to New York and Los Angeles. But New York is a really big FX market, so we don't go all the way, but technically you can go all the way from Wellington all the way to Los Angeles, extreme east to extreme west. Markets are open from Monday morning in Wellington to Friday closing in New York. So international FX markets, and you have cross rates. So what is a cross rate in the international FX market is FX markets, remember FX pairs, okay? Remember how we have defined market? We have defined market as a venue for exchanging two assets for one another. Euro versus sterling, dollar versus Swiss franc, dollar versus USD versus Canadian, sterling versus yen, etc. Right? So that's why these are called FX pairs, because these are two currencies matched against each other. But every market is actually a pair based on the way we have defined markets. There's a venue for exchanging two assets against one another, and one of those is usually a currency, and at least one of those should be defined as as a currency. And in this case, both are currencies. In the foreign exchange markets, both are currencies. When you're looking at this asset class called currencies, both are currencies. So what is the terminology? So FX markets it should be right on top actually. FX markets can be of two types. You can have international FX markets, and then you can have Indian FX markets, and in both markets you'll have a definition of cross rates and dollar trades. Okay, and we don't need all these underlines. Yeah. All right. So FX markets, international and Indian. All right. So let's put them here. Put them international. International centers generally are convertible currency locations. All right. So what do cross rates mean in an international market? Any market not involving, I won't write the USD, I'll just involve USD, okay? Not involving USD, okay? So cross rate example would be sterling yen, example, anything. You can think of all these examples. Sterling yen, you can think of euro sterling. Okay, what is the distinctive feature of these markets? Cross rates in the international markets. Okay, FX cross rates. I want to just fit everything in one line. So FX dollar trades, and so this is very simple. Any market involving so I'll give you similar examples. I don't know why it's not fitting in one line, but anyway, let's put the examples on the next line. Okay, so the international markets, the convention is that foreign exchange cross rates are any market, when we talk about cross rates, any market not involving US dollars. So euro yen, okay, and you can have actually you can actually have full quote board asking for cross rates. Okay. I was trying to look for some Netanya cross rates, but we'll just look at, you get the idea. We can look at it here itself. We can identify the cross rates. This involves US dollars, so this will not be a cross rate. This is not a cross rate. All involve US dollar. This is a cross rate because the US dollar is not involved. This is a cross rate. This is a cross rate. This is a cross rate. So is this. Okay, now you get the picture. Okay. Anything non-involving cross rates is, and similarly you can get all the other, any kind of quote system that you look at will will generally show you this. Okay, so very simple. International markets, FX cross rates, any market not involving US dollars. Okay, FX dollars traces any market involving the US dollar. Okay, so in this case the example should be, we'll just keep this the same, Euro USD. All right, so this is the convention that we use. This is the terminology we use in the international FX markets, which is that cross rates in any market not involving dollars. any market involving dollars is called a dollar straight. Okay, it's called a straight because it's kind of like similar to what we say. So it's FX dollar straight means it's a straight dollar rate, which is basically to say that this is normally the convention in that most of the activity is concentrated in the main dollar exchange rates. So these are the straight dollar exchange rates: euro versus dollar FX, dollar versus yen FX, sterling versus US dollars, dollar Swiss franc, dollar Canadian. Okay, this is where most of the activity is. They're so straight in the sense that the majority is like this. So dollar straights. Okay, straight means kind of like straight versus gay or whatever, where the majority of people are probably straight. So therefore, you say straight is the conventional or the majority case, and so dollar straights. Okay, simple, straight, conventional stuff. So dollar straight, any market involving the US dollar is the dollar straight. Okay, and these are cross rates, not involved US. In the Indian FX markets, it's we'll just copy this from here. It's a different. If you go to work in a trading room in Bombay, people will say any market here, this will become INR. Okay. And this will become, we don't use the word dollar straight here actually, so we don't actually use this as such, but this is not really used, not really relevant. Okay. Sorry, I had not put my phone on. Okay. Just give me a second, okay? I may need to just take this call. Recording? Okay, good. All right. So in Indian FX markets, FX cross rates refers to any market not involving INR. So it would include both sterling yen and would also include this. It would also include, so in a Bombay dealing room, if somebody says, what are the crosses? They include crosses, sometimes referred to as cross rates, also called this terminology is used in international markets also. Okay, so if you're listening to BBC Financial News, you can see on the crosses, they'll use something like on the crosses. So, or crosses, okay? Cross rates or crosses. So this is the terminology that is used, or crosses, okay? All right, so FX cross rates across any market not involving INR, not used generally. For obvious reasons, okay? Because the reason you don't use dollar straights in India is because whether it involves a US dollar or does not involve a US dollar, you are referring to it as cross rates because it does not involve the INR, okay? So the question of then making a separate category for dollar straights doesn't arise because you have put dollars also into this. Dollar straights have also been put into this. So the lesson of this is, once again, that you should not learn foreign exchange with a focus on Indian markets, because many of the things we do, many of the terms we use are not consistent with international markets, and these markets are much bigger than our markets. Okay, we are because of the kind of stupid policies we have followed in the regulatory sphere. Our country is financially much more backward than it needs to be. We are a fairly big economy, so our financial market should be much more developed. And this has a direct implication for all you guys, your job opportunities, your salaries, everything is kind of artificially depressed because, every party, it's not a matter of Congress or BJP, it's the bureaucrats who make the policies. They're all, anti-free market, socialist kind of people. and therefore they have stupid policies, over-regulated markets, and that's why Indian markets are not well developed. And we don't follow international conventions. We should not be using this kind of language. We should use language that is consistent with international markets. You go to work in London or Singapore or New York, this is the terminology that you will be using. Everywhere they use the same terminology. London, New York, Singapore, Zurich, Dubai, everywhere you go, they use the same terminology. But in India, we use a different terminology. You should learn this. That's why you don't learn finance with the Indian market focus, all right? So, so you understand one difference between the use of cross rates and the use of the term cross rates. And there was something else that I wanted to mention in this regard. I'm just slipping my mind at this point. Okay, yeah, one more thing that we used. This is one example. Another example of just giving you some information. This has been corrected now. Another example of use of terminology that's inconsistent with not international FX markets, but international markets was RBI and bond markets. Use of terms, you know these terms, repo and reverse repo. Okay, so both RBI and the Indian bond markets used to use. So Indian bond markets will use whatever RBI uses. Okay, because they are kind of dependent on the RBI. And every bond market is dependent on the central bank very heavily. So use the term repo and reverse repo, which was earlier use. I want to make this clear that this has now been rectified, but it was the case for many years, and therefore it was again not correct. We should not be inconsistent with Indian markets. Earlier use of the terms repo and reverse repo, which was the opposite of the international markets. Yeah. Just imagine. So we were using repo, and we were using repo to refer to what international markets would call the reverse repo, and we would use the word and vice versa. So it was vice versa in the sense that and we were using the word reverse repo to refer to what international markets would have called the repo. But thankfully, this has now been rectified. Okay. All right. So two examples of why you should not study finance with reference to Indian markets. Okay, the terminology that we use, we are so out of touch. This is the globalizing world. We are coming from a developing country status. We are going towards developed country status, and we have all these stupid policies. Is holding back the development of markets, and we don't use terminology that is consistent with international markets. So this is not correct, actually. So this is one of the reasons why I don't teach you finance with the Indian market focus, like they do in many business schools in India. Finance is not a topic that should be studied like that. Marketing should. Strategy should maybe even, but not finance. Finance is a global subject, and it doesn't make any difference whether you do option trading in India or option trading in the US. The theory is exactly the same. Okay, so two examples, okay, of inconsistent terminology before we get back into cross rates. So a little bit of contextual background. Remember, while discussing Indian markets, I'm repeating the advice, very important for your interviews. All the 3 textbooks that you will receive, there will be Indian, this is there in your session notes. This advice is there in your session notes somewhere, okay? your responsibility to study the India portion of the session notes. Okay, you will find somewhere there will be India portions. There is some material on the India portion, and it is your responsibility to study that and find out what is written there. And this is just in the nature of, maybe I wrote it in the previous course. Okay. But you have to go through your textbooks, look at any part where they're talking about Indian markets, and read that part, because it's generally in the nature of information, okay? But you have to acquire that, you have to know that information and read it, make sure you know it. I'm not going to waste my time on it because I don't want to tell you information about, okay, this is, Calcutta is 5 miles from so-and-so city. This is just information, you can read it somewhere else. So I'm going to use my time on conceptual clarity and other important contextual information like what we just discussed. Okay, so let's go back to the application of AFV for cross rates. All right, let's look at, and so we are using cross rates in the international market trade context. Okay, let's look at it this way. Now, let's go back to, let's go to our calc sheet session board. So we are going to now see an application of AFV in foreign exchange rates. Okay. Bring this back. Just want to get a subtopic here. Okay. Let's look at examples. Now, let's take you back to refer. Where should I, where did I actually, I referred to a cell number. I'm so lazy that I want to copy this actually. I'm so lazy that I want to not make sure that I don't repeat this. I'm just going to copy this and I'll use a different cell number. Now we are going to go to the spreadsheet, so I want to refer you to that. And where should we write it? Now let's say today is what? We will look this. Let's take this here. And this discussion. Okay, so today is not 8th December, this is 12/12. And our topic is AFV. Actually, our topic is full. AFV for cross rates plus dollar trades. This is the topic we're doing here. Right. Give it a nice color. Right, okay. So let's look at a situation where we can write stuff here as well, right? Why waste the space? Let's write stuff here as well. So let's look at Euro USD, and let's look at Euro Yen. This chart we used was Euro Yen? Yeah, Euro Yen. Okay, so let's look at this. We can now actually just take some prices. So 121.10, we'll take it at 121.10. Okay. Let's understand the concept first. 121.10. Let's talk about the mid price. Okay. Let's talk about prices. this is the mid. This is the bid, the mid and the bid, and middle would be the sit, but it is the offer. Okay? So mid and the bid and the offer. We will put some gaps in between. Okay, so here we have this, then we have, we create a little bit of a gap further, and then we will have, this should be, this one is $2 yen, all right, and then we will just, all right. So here, let's put the mid as 121.10. This is normally quoted to 4 decimals. See, now you have a pipette also on the 5th decimal. It's so competitive, but we'll just use 4 decimals. Okay, so we have AFD from cross trades. We are referring to, now I have to change this, this is fine, but I have to change the cell reference. The cell reference is, we'll just call it, what is this, 50, yeah, 53 and A53. And we will not give the other cell reference, it's fine, we'll see where we close it. So A53, so let's refer to A53 in the session board sheet, and let's make sure that it opens that page. Yeah, it'll open some page and it'll take us to, you can go to this cell number, okay? So cell A53 is where we are, okay. So Euro USD we note down as 121.10. Then dollar yen we will note as 103, or we'll just call it 104. Okay. Well, let's make it 103.96. Let's see. Let's make it 103.96. And let's make this. This is 125. We'll call it 90. 125.90. Rounded up to 125.90. So here, Euro JPY has to be written twice actually. And we also want to have a Euro JPY. Let's see. I'm just trying to save myself. So this is how we refer to it sometimes. We use the word synthetic, and in contrast, we use the word direct. So direct means what price can I get by trading directly in the market for Euro Yen, and there is a market for Euro Yen. It's an actively traded cross. It's the most actively traded cross actually. So 125.92, okay. 125.90, we'll call it 125.90. And so that's the direct price of Euro Yen. If I go into the direct market for Euro Yen, as you can see, prices are quoted directly. And the other way to do Euro Yen is to do it synthetically. And so we can also look at the synthetic price, okay? So we'll just put this a little bit. Maybe just reduce the font size a little bit. Don't need to make it 18, right? Just make it a little smaller. So I can so here we have 125.90. Okay, so I'm just going to put down 125.90. This is not a percentage figure. This has become copy this here, and then we'll formatting remains. Okay, so this is what we see in the market. Okay, and as far as all the other things are concerned, we will make sure that everything is center aligned. It looks better. Okay, so these are the prices that we see. Now this is the direct price here. Now the question is, if you did not have this direct price, okay, what would be the synthetic price? Okay, can you figure out, or you have a direct price here, and you compare it to a synthetic price which is different? Okay, so let's assume here that if we have 121.10, so first we'll do the analysis so you understand the concepts. First we'll do the analysis with respect to we will assume that bid and offer are the same as the mid. Okay, so we assume that you can buy and sell at this price, buy and sell at this price, and buy and sell at this price. So we will make that assumption to simplify the concept. So first, let's understand what is the theoretical price for the euro-yen synthetic. Okay, let's try to understand that. Okay. Now, okay, in euro-yen, okay, so euro-yen is equal to 125.90. All right, so that means that 1 euro okay, 1 euro is equal to 125.90 JPY. Okay, so or we can write mathematically, we can write so mathematically we can write can we write this here? Okay, so what we are saying is that let's write it here. So it's kind of like rough work. So it is like JPY here and euro here. So it is actually JPY per euro. So when we say JPY, euro yen is 125.90. It is a bit like saying that we divide the yen by the euro. Okay, so the numerator is the JPY. Okay, maybe we can write it here. That is 1 euro is equal to 125.90 yen, or okay, or what we say is that JPY here numerator and EUR equal to so again I'm doing it from a very basic approach, using going from first principles, so I'm making sure that nobody has any confusion. Okay, euro is the denominator. Yeah. So this is how you write it mathematically. So 125.90 means that it is JPY divided by euro. Although we write it in such a way, okay, it looks like euro divided by JPY. But this thing you have to remember here, this stuff that we are writing, this is not a division sign, okay? This thing here is not a division sign. This is just a label. Okay, so it's just a label to indicate that dollar is the base currency here. Euro is the base currency here. Euro is the base currency here. This is not a division sign. Now when I'm talking about this, now we are using this as a division sign. Okay, so now when I start saying this means that because euro is the base currency, euro yen 125.90 means that 1 euro is equal to 125.90 yen. That means that mathematically I can write this as JPY in the numerator and euro in the denominator. That equals 125.90. Okay, that if I do this, that leads to 125.90. So Therefore, now our question is synthetic euro yen. Okay. Synthetic euro yen price. So this exercise is important for you to understand how, and this kind of fundamental general principle based knowledge, the process that you're going to apply here, you can apply it in other asset classes, in other instruments as well. The thinking is exactly the same. Okay, the thinking process is exactly the same. Synthetic euro yen price, how do we derive it from direct prices for, what are the two that we are going to need? We need this, and we'll make the dollar cancel out. Okay, we'll make the dollar cancel out. So then we'll be left with this synthetic equivalent. Okay, this is how we're going to do it from for Euro USD and USD JPY. Okay, so this is actually almost like a subtopic kind of thing. Okay. Okay, how do we do this? Synthetic. So first understand what is euro yen. So I need a situation where it's a little difficult to portray it, but let's talk about this here. Okay. So I need, now I'm writing it as divided by. Okay. So this is a division line. Now here, let me put it this way. I'm writing it like this now, so that everybody understands what I'm doing. Use the coloring. Numerator and denominator. Okay. Now we know what we're doing. Okay. So in the case of euro yen, how do we write this? Okay, let's try to write it like this. Euro yen, we're saying is numerator is 125 yen, and everything here should be also centered, leaving out the first column. Numbers look much better if we center them. Okay, euro yen, let's call this EUR. Okay, we can copy this from here. Leave out a little bit and put this here. Okay. All right. Now, numerator, denominator. Okay, euro yen, and this is obviously 1. Everything here will be 1. Now, in this case, what is the numerator here? Euro USD 121 means, what is in the numerator? Let's put it this way. Let's do that in the text first. Okay. We'll repeat this. Now, we'll repeat it twice. Now, we'll first repeat it here. Now, Euro USD, we are saying is 121.10. Implies that 1 euro is equal to 1.211 USD. Okay, or in this case it is USD divided by EUR. Okay, or in this case, what is the numerator? Dollars or euros? Anybody? I hope everybody hasn't fallen asleep by now.
It will be USD.
Numerator is
Yes,
USD.
sir.
Correct. Double A. Good to see the battery is fully charged. And USD divided by UR. So in this case, the numerator is USD is the numerator and EUR is the denominator. Okay. Yeah, it's just 121.10. We'll just use this. Okay, and using a similar logic. All right. Okay, so in Euro USD, in the case of Euro USD, it's 121.10. And then once again, we want to clarify that in the case of USD JPY, which we have taken as 103.96, okay, 103.96. Then in the case of USD JPY, right, let's say, so we'll break it up visually for you guys so that it's easier to follow. Put this in bold, then we can break it up visually. Okay, right. Dollar yen we have said is how much? 103.96. Okay. So 103.96. Here again, base asset is US dollars. So this is 1 USD is equal to, and in this case, maybe we can copy from here. Okay. Copy from here and put it down here and write it as 1 USD is equal to, let's see if this works. Yeah, 1 second. So this will be, okay, so 1 USD is equal to 103.96 yen. Okay, or this is again JPY. Is equal to USD divided by EUR. USD numerator, Euro denominator is fine. Dollar yen here 103.96 means 1 USD is equal to 103.96 JPY, or JPY divided by, this should be USD. Okay. All right, JPY divided by USD, or JPY numerator and USD denominator. That gives us 103.96. So we're going to write this now. Okay, 103.96. So now we have written this here in the text. Okay, now we can put it here. And we can write, in the case of Euro USD, numerator is obviously euros. Formatting. So in the case of Euro USD, numerator will be 121.10. And in the case of dollar yen, 103.96. Okay. Right. So how should we write the synthetic Euro yen synthetic, okay, formula? It should be pretty simple. If I want to get a synthetic Euro yen, okay, first let's think about it mathematically. If Euro yen is equal to is JPY divided by euros, okay, and I want to create this situation through this and this. Here, this is Euro divided by dollars, okay, and this is dollars divided by yen. So I should multiply these two, or should I divide one by the other?
Multiply, sir. You should multiply.
I should multiply this. Okay.
Sir, yes, multiply.
Yeah. So if I multiply, then here dollar is in the numerator and here dollar is in the denominator, then they will cancel out, and I will be left with euro in the denominator and yen in the numerator. That's what I want. Okay. So therefore, actually, this is better done in the text part. So what we know is that the synthetic euro yen should be equal to the multiplication of these two rates, okay, the dollar euro dollar FX and the dollar yen. Okay, as you can see here, these two turn out to be, as we have taken actual market rates and rounded off a little bit, okay, and 121.10, this is a reasonable rounding. This is also a reasonable rounding. And this rounding is, you could say, a little unreasonable because it is 125.92. So let's do a proper rounding. This 121.10 is correct. The 103.96 is correct. Let's do a proper rounding for this 125.92. This becomes 125.92. So there is a difference, okay? And once again, you can see that here you can see how with a particular application to foreign exchange markets, you can see that it's always one. Yeah, okay. All right. So you can see with a particular application to foreign exchange markets, understanding how this requires you to understand how foreign exchange rates are quoted. When you look at the market display, this is why I said that you need to have both conceptual clarity as well as contextual knowledge. So this is contextual knowledge. When you look at this, you might go, my God, what does this mean? I don't know what this means. What is it? €1 is equal to dollars, or is it $1 equal to so many euros? This is where your contextual knowledge comes in. You understand that here the base asset is euros, so this means this many dollars for €1, etc. That's where your contextual knowledge comes in. You combine that with your conceptual clarity, and you understand the synthetic equivalent, how to arrive at it. And you see that the synthetic price, assume you can buy it, this is equal to the bid and the offer. This is equal to the bid and the offer. The synthetic price is 125.90 and the direct price is 125.92. Of course, this is not actually very correct because now the market has closed. So the market has closed. So this last trade in the euro yen may have been a little earlier than the last trade in this and the last trade. We don't know when the last trades happened in these three markets. So this price may be a little bit delayed relative to this price and this price, okay? So in actual fact, in the foreign exchange markets, you will not even find this much difference. It will be exactly the same, okay? And we'll explain how, let's understand that also as a process as to why this is exactly going to be the same. But first thing, straight away, you understand what is the application of AFV. Once again, let me repeat. This whole context of valuation, all these discussions you have, they only make sense in the context of this original problem, buy or sell, okay? When I'm looking at a market, instrument combination, spot euro yen, I'm confused. Should I buy or should I sell? One way to solve that confusion is to put yourself in this box. Say, I don't believe in TA. I want to use this. I believe in fair value, comparing it to market prices. What ways to arrive at fair value, either this or this. I'm going to use this here because I think I can. I'm going to use true AFV. I'm going to look at market prices. I'm going to derive I know what the market price for euro yen direct is. I saw it over here. It's the market price. Then I will look at the market price of related markets. These are related markets. Using these related markets, I can construct a synthetic euro yen price. Okay, it's a synthetic price. It comes from these two prices. Notice no forecasts involved. Okay, no forecasts are involved. That's why it's put here as a separate category. Girls are not boys, boys are not girls. AFV, true AFV is not dependent on forecasts. Okay, so therefore you can see I can arrive at a synthetic price using no forecasts, using available market prices. I can instantly trade on these, okay? and I will just, this is the fair price. Now, another thing to be thought of is, what are you actually going to do? Okay, so here now you know that, let's look at this. Let's do the application of the arbitrage here once again. Let's note down these two things. And let's note down this. Okay, so what do we find? We find this is equal to and this one means I need to plug in my router. You just hear a sound. Okay. All right. So 125.92 is the direct price, and this is 125.90. Okay. What do? I call up my theoretical knowledge base. What does my theoretical knowledge base say? I call up in my brain, I recall this stuff that I learned about how to use AFV, how to derive this, recall this theoretical knowledge. Okay, then I apply it. Okay, so in this case I find synthetic is cheaper, direct is more expensive, so I will sell the direct and buy the synthetic. Okay, so selling the direct, so therefore, so here so I apply it, apply the concept. So here so we buy synthetic at 125.90 and have it in capital percent. We buy synthetic and sell direct. Okay, we sell the direct position, we buy the synthetic position, or we sell the direct market and we buy the synthetic market. Now this part is very clear, okay, because there is a market, so this part is very clear. We sell the direct market at 125.92. This is clear. We have assumed that these are actual prices. We have assumed that this is the mid is equal to the bid is equal to the offer, okay, in all these cases. So this part is very clear. I just go to the market maker here, I ask for a price in euro yen. He says 125.92 choice. Remember, the price will be quoted as 125.92 CH. This means there is no separate bid and offer, which means it's your choice as the price taker. You can either sell to me at this, treat it as my bid, or you can buy from me at this, treat it as my offer. the price is equal to bid is equal to offer is equal to 125.92. It is quoted as 125.92 choice. So the price will be quoted to you as when you ask for euro yen in 10, which means 10 million euros. You are asking for this price. The guy quotes a price saying 125.92 choice. That means that you can either sell or buy at this price. And remember the ethical, professional standards. You do not refuse a choice price. If somebody quotes your choice price, you must deal on that price. So don't just arbitrarily go and ask for prices. Because if the guy quotes your choice price, you will have to deal. Okay, so this part is very clear. Okay, we know how to do. We call up the market maker. We call up the market maker and ask for a price, and we sell to him at 125.92. Now, how do we do this?
Yeah. Does it mean that if we are selling, if the market maker is quoting at the price at choice and we are taking it, so does it mean that it won't have any slippage? Like they won't have any slippage, the market makers?
No, that is his estimate. Okay, this is just like so some guy quotes, he has a lot of inventory, he's quoting some, he may suffer a loss or whatever it is. I mean, he may have some position or he may have some kind of interest. Okay, sometimes people offer something at a heavy discount. Some dealer is offering some washing machine at a heavy discount. Now he may have maybe he's got he wants to sell. So why is he offering a heavy discount? He wants to make sure that he's able to sell it. Somebody picks it up. He's offering such a good deal that people will come rushing and buy it up, because maybe he's got too much inventory of that model of washing machine. He wants to get rid of it, basically. The only thing you can conclude is that he wants to get rid. He wants to, or he doesn't really care either way. Okay, or there may be many motivations. He may have like. We may be trying for, let's say I'm Citibank Bahrain, if I use my example where I used to trade. So if I'm Citibank Bahrain and we get a quote and we get a call from, let's say, a big investor, okay, maybe the Saudi Arabian Monetary Authority called SAMA. We get a call from SAMA asking for a price in, maybe dollar yen and 500 million. And I want to create a good impression with this customer because it's a big customer, okay? So sometimes when you get a big customer and you want to build a relationship, you will quote them a very good price. You may actually lose money on the deal, but the idea is you want to basically show off and, put yourself in a good light in front of a big customer. So there are many reasons why a dealer might quote a choice price. We don't really know anything about, we can't read his mind, so we don't know what his motivations are, but there could be many motivations, right? So maybe he feels that the market is not going to move that much or whatever like that. So you can't really make a conclusive determination as to what his motivation is for quoting the choice price. The only thing you do know is that if you're a professional foreign exchange dealer, you must deal on, that's why you don't go around asking, sometimes people do this, you may know this coming from business families, sometimes people go around asking for prices, just checking prices, they go checking prices, they go and ask many dealers, oh, what's your price, they have no intention of buying or selling, but they'll go around asking for prices. So you should not do that, because if somebody quotes your choice price, the ethical standard requires that you deal immediately on that price. You have to do something, buy or sell. Is this clear, Siddharth? Does it answer your question?
Yes, sir. Sir, but the reason I'm asking is, sir, because we have this arbitrage opportunity here, and sir, does this happen? Is this normal to happen? Like in options also and in forex also? And sir, if this happens, like the difference might be low. And sir, if we are trading on a software like in options, there is so much slippage, we don't get the exact price. So does it not cover that, the slippage also? We take into the account the slippage.
No, okay, I didn't really understand all the parts of your question, but the first part I understood, and that is that, as I said here, I already clarified, already mentioned this to you, that in the foreign exchange markets, they're very liquid. You will not normally find this kind of discrepancy, okay, and we'll come to why you will not find it, but you will not normally in liquid markets, you will not get these opportunities. I'm just showing you this, although from real prices, but as I said, this probably, we can't be sure that this snapshot, because now the market is already closed. Last night in New York, the market closed, okay? So these are all dead prices. These are not live prices. These are dead prices. Now, maybe this price is 15 minutes older than this price. And maybe this price is about 2 minutes older than this price. So these are not three prices taken at the exact same point of time. That would only be true when you open up the market on Monday. Let's say you wait for London to come in on Monday and say around 6 p.m. or something our time, or 5 p.m. in the thick of London trading, as New York is about to come in around 7:38 or whatever. You take the price, and then you know these are liquid, actively traded markets. You take a print screen at that time from real traded prices. So you should look at your TWS, set up the foreign exchange quotes, and look at, there you'll have bids and offers separately. Okay, we haven't even gone into the discussion of bids and offers. That will complicate matters a little bit more. Okay, but I wanted to first make sure that everybody understands the theory. Okay, so that's why we are doing it. So the first part of your question is, normally you will not get these kind of opportunities. And if I understand the second part of your question properly, I think what you're saying is these are all relevant questions at this point of time in the discussion. So that's why I'm answering them right now instead of leaving them for after the class. So his questions are directly related to execution of the arbitrage. Okay. So that's why I'm answering it here. In general, that's why you have to see, that's why I talked about, I have a plan to talk about bid and offer. We may not get the time. But in practice, you have to look at all the details, all the details of the execution. Okay, that's why we are first going to understand the theory without complicating things by looking at separate bid and offer prices. We are going to assume that bid and offer is the same as the mid price. But then first we understand the basic concept, then we complicate it a little bit more. One first level complication, then second level complication, and so on and so forth. So options is several levels of complication, but the basic idea is that you have to get into the entire mechanics of this transaction. You should be able to buy the synthetic, sell the direct instantly without any movement in this price. The slippage that he's referring to, you could loosely refer to, use that to understand the difference. Moving of this price, this should not move. I must be able to buy it 125.90 and sell it at 125.92 instantly. And there should not be, I should be able to get this price. I should be able to conclude the deal at this price. So, and therefore it applies even in option trading, which means every leg of the transaction. Remember, we discussed that tea bags example. So I should be able to sell the hot cup of tea, ready-made hot cup of tea at 105 rupees right away. And instantly, at the same time that I sell the 105 tea cup, ready-made cup of tea, I should be able to instantly buy the hot water, the tea bags, and the sugar and the milk sachets, all for a total cost of 100. So I have to make sure that I can actually execute these deals. It's not a matter of just looking at it theoretically. Can I actually make it happen without any movement in the price, without any phone connection going down? That's why all these operational risks will still remain. But if I can do it, okay, then I'm only left with contractual risk of, I get into a contract with Siddharth and he does not pay up. That's a different matter. That's not included in, so if I can sell to Siddharth, lock in my transaction, then I assume that I have sold to him, and then I assume that he will honor the deal. That deal might mature after 6 months. So if he doesn't pay, I'll only realize after 6 months. But for the moment, I will consider it as a done deal and an executed arbitrage. Does that answer some of your questions, Siddharth, what you're asking?
Yes, sir. Yes, sir. But yes, sir, that's why I was asking, because when we trade options, even if we put the limit price, we get the best price. We don't get the exact price which we quoted. We only get either a higher price or a lower price.
No,
So
one second. Limit orders, you should get, if I say sell dollar yen, if I say sell euro yen at 125.92 limit, if I have a sell limit order for euro yen at 125.92, okay, it will not execute at a price less favorable than 125.92, which means in this case of selling, it will not be below 125.92. It'll either be this or better. That should always be true in the case of limit orders. But market orders, there is no price guarantee, right? You should be clear about that. That limit orders will be never less favorable than the limit price. But market orders, there's no price guarantee. So I may say sell dollar yen, sell euro yen at market. When I say that, the market might be 125.92. By the time my order gets done, it may get done at 125.70. No guarantee. Okay, I can't say anything to the dealer because I did say sell it at market. This is clear, Siddharth?
Yes, sir. So the reason might be something different because when I bought an option, what the price which I quoted, I didn't get it. I didn't even get the best price. So it was a little favorable for me. But I guess it was due to either the commissions or something else.
Yeah, you have to include the commissions. You have to include the commissions. But once you include the commission, the limit price can never give you a execution at a price less favorable if it was a limit order. So maybe you did not include the commissions. The commission you have to include. But otherwise, including the commissions or assuming no commissions, the limit price can execute at a price worse than what you gave. A limit order.
Okay.
Not possible.
Sir, does this like it is kind of easy for market makers to do this at high volumes? Do retail investors also engage in this arbitrage?
No. Let me just clarify that. There is no general answer to that question. It depends on the situation. As I said, in general, in a liquid market, actively traded market, you will not even get this kind of small difference. You will generally not expect to get it, but that does not mean you don't look for it. There are some people who spend their whole lives, their business is to look for these opportunities. But you can't expect too many of them, okay? And so there is no general opportunity. It all depends. Sometimes things get out of line, some kind of disruption happens. So you can't have a general answer to the question. In general, we can only say that these opportunities will be very rare, okay? But they can happen. It's not theoretically impossible, okay? It's theoretically impossible to sustain it, but momentarily it may appear. That may be due to some kind of disruption, or you may think that there is an opportunity here because we see a difference of 2 pips, but it may be because this price is a little more recent than this price, and this price is even more older than these 2 prices. So you have to be sure that these are all current prices at the same moment of time, and you can actually lock in the whole transaction. So yes, if you can, even a retail investor, there is no reason why they can't do it. But as I said, you have to examine the situation at a point of time. There is no general statement or guarantee that you will get it or you will not get it. But if you can access it, if you are able to execute the whole arbitrage, then of course anybody can take advantage, either a market maker or retail investor, anybody can do it. It all depends on the whole thing here. It all depends on, in the real situation, this is the theory, but in the real situation, do you have the circumstances, including commissions, including bid offer prices? Because in real life, you'll have to buy at the offer and sell at the bid. And here the bid will be, if it is, say, the bid will be 121 and the offer will be 121.20. Of course, in real life, the bid and offer is not going to be this wide, but I'm just giving you an artificial example, okay? So that's why the mid is 10. This is 0, this is called figure, and this is 20. So 20 minus 0, 0 divided by 2 and plus this. So therefore comes to 121.10 mid price. Okay. So in real life, you'll have to sell at the bid, buy at the offer. So you have to make sure that in real life, you can actually execute this arbitrage. Okay. So therefore, it all depends. Now, does that answer your question? These are all still relevant questions because all the questions that Siddharth is asking are related to understanding this concept of arbitrage-free valuation and how to put it into practice. So therefore, I've answered it in the session itself and not after the class. But this is the idea that I hope everybody has got the idea of that what Siddharth is asking and what I'm answering, that there is no general answer to the question of whether retail customers can do it, only market. Even market makers, there's no guarantee, okay? There's no guarantee that you will even see this. You have to remain alert like a watchdog. You have to remain alert if you're in the arbitrage business. Remember, one category of business is, we are already at the time, but I will just take 2 minutes to, I didn't set an alarm for the second session, but I'll just wrap up in 2 minutes that in the arbitrage business, if you're in the arbitrage, remember one category of market player is an arbitrager. Arbitragers who are like speculators and hedgers. This is one of the three major categories, and leaving out the government. Okay, so the arbitrage people, the people in the arbitrage business, this is what they do. They spend their whole day looking for these opportunities. Now, they may go for 6 months without seeing any opportunity, but that's life. But if they see it, they are ready to capitalize. That's how they set up the whole technology infrastructure of their business. Monitoring the prices, trying to execute quickly if they see any opportunity. Okay, so what will happen basically is that as people do this, I'll just quickly wrap up on this. We have about 1 minute extra. As it's important to understand this, why you will not see these opportunities, okay, because basically nobody's going to quote this price, okay? The reason you will not see this opportunity is that this guy is not a fool. This guy who's quoting these prices is not a fool. He will already have on his spreadsheet the fair value that is consistent with these two. So he will already have the synthetic AFV, okay? And he's not going to quote this price. He will quote this price because he's not a fool. Okay, that's one. Second is, as the reason that you will not have two different prices like this is because as people do this and as people buy the synthetic, excess demand here, prices go up. Excess supply here, prices go down. 92, 91, 90, 90, 91, 92. This converges to this. These two converge. Okay. So that's why, okay, that's why these two prices will basically not remain apart for very long. As people try to do the arbitrage, the prices will converge. You will get what is called the law of one price. Okay, so I'm not going to, we are already 2 minutes over the time, and I like to stick to the time or make sure you guys have your lunch. So we will stop it here. And so that's the end of your syllabus. Whatever we've covered in the class is your syllabus. And so at this point, I will dismiss the class. And those who have questions can remain. And Sachin should remain. If Sachin here, he had asked a question about...
Yes, sir, I have a question, sir. I have 2-3 questions.
Yeah,
after
we will also talk about your problem that you had with the...
Yes, sir.
So the class is dismissed, so the course is over. I hope you guys learned something useful. And so good luck for your exam. And make sure you understand all the concepts, okay? All right, so class is dismissed. You guys can go and have lunch. And Sachin should stay back. And anybody else who has a conceptual question. So I will first address the conceptual questions, and then I will look at administrative matters. So yes, Sachin, your question is conceptual?
No, sir. No, sir.
Okay, yours is administrative matter. Okay, so leave us. Anybody else has a conceptual question at this stage?
Sir, like you told us about the liquidity in currency markets is very high. Is it the same in options market also? Like the arbitrage opportunities are also very less there
No, well, option
for
markets.
synthetic?
No, it depends on which option market you're talking about. That's one of the reasons I'm making you guys trade US equity options, is because that is the most liquid set of markets available in equity options. Now, if you traded equity options for India, if you're trading Indian equity options, they will be much less liquid than US equity options because our markets are not so developed. There's no reason why they have to be, but as I said, because we have followed stupid policies, we don't have a convertible currency, we have all kinds of restrictions. So the number of players in the Indian markets is very less, it's much less. So therefore they are less liquid. So as to the question that you're asking about the liquidity, the relative liquidity of different markets, different market instrument combinations, the answer to that is that's part of your contextual knowledge. Like I'm telling you now that Indian markets are less developed, less liquid. US markets are the most liquid. So this is something you find out by investigating. Okay. So this you have to investigate individual markets and find out. And so it is a kind of like a case-by-case basis. There is no general statement that option markets are liquid. It depends on which country are you talking about, right? Even in a country, different markets might be different. Different types of markets might have different liquidity patterns. So yeah, so that's the case-by-case basis investigation is required to answer that question. Yeah, so that does it answer your question?
Yes, sir. And sir, one more thing, sir. If the one condition, is that a condition that both the transactions have to be simultaneously executed? Like if there is a time difference, would it would still be arbitrage or it would be not?
No, you have to make sure. So in general, they would have to be done simultaneously because you have to make sure that you can capture this, that you can actually enter into a buy contract, conclude the contract at 125.90 and conclude a sell contract at 125.92. Now, the guy you contract with at the end of the 6 months, maybe it's a 6-month forward contract, and at the end of 6 months, this guy can actually default. That's a different matter. That's not market risk, that's credit risk. Okay? So, but yes, you have to, there is no, in general, there should not be any time difference. Or maybe 1 millisecond or whatever. Okay? But no time difference because you must instantly lock in both the prices. If you want to have true, I'll just write down here the buy synthetic. This part is very clear. You call up the market maker and say, what is the buy? Buy euros and sell yen. So here buy synthetic will have 2 parts. I'm just writing it quickly. Buy euros and sell yen. So you will have to basically buy euro USD. Okay, that means buy EUR and sell USD. And I want to just complete the discussion here. How? This I was going to ask you guys this. Actually, I was going to have a little bit of a CP session for this, but we don't have the time. So buy synthetic. How will you buy the synthetic? Okay, you're trying to buy the synthetic euro yen. Okay, at 125.90. How will you do it? Your only way to do it is to trade in these markets. What will you do? Okay, so the answer to that is figure out what you need to do. You need to buy euros and sell yen. You do it in 2 parts. First you buy euros and sell dollars. Then you sell, then you buy euros. What is it here? You have to buy euro USD. You have to buy the synthetic, right? Yeah, so you have to buy euros and sell yen. Okay. So you have to first you buy euros and sell US dollars. Okay. And then you buy US dollars and sell yen. Okay, so the second is going to be buy USD and sell JPY. So the net of 1 and 2 equals buy euro and sell JPY. Okay, because buy USD, sell USD cancels out. So you have to remember that when you do the buy sell, you do the final transaction for to buy the synthetic. What you have to do is two transactions: buy euro and sell US dollars, buy euro USD, and this is here. It should be buy USD and sell yen means buy dollar yen. It should be an implied sign. Buy dollar yen. Buy euro dollar FX, which means buy euro and sell your dollars. Buy dollar yen, which means buy dollars and sell yen. Buy dollars, sell dollars cancels out. You're left with buy euros, sell yen. Buy euro, sell yen means synthetic long euro yen. Okay. So when you do this, you have to remember one more thing. That's why bid and offer comes in. You're buying euros and selling dollars. You will have to buy euros and sell dollars. You will have to deal on this guy's offer price. All right. Then what are you doing here? You will have to buy dollars and sell yen. Okay, if you have to buy dollars means you will have to again deal on the offer price. Okay, you'll have to deal on the offer price. So here we can say 96. So let's put $3 difference here, 3 pip difference. So 93. Let's call it 93. Let's call it 99. All right. So 93, 99, 6 pips, and so add 3 pips. 6 divided by 2 is 3 pips. Add 3 pips to 93, that gets you a mid of 96. So this is a illusion actually. In real life, you have to start looking at what do I need to do to buy the synthetic. Selling direct or buying direct is very easy. You have a price, you go and sell and buy at that price. Synthetic is a little more complicated. How do I create a synthetic long euro yen position? That is buy euros and sell yen. I have to first buy euros and sell dollars, then buy dollars and sell yen. These two will cancel out, leaving me with buy euros and sell yen, which is what I want. If I have to buy euros and sell dollars, I'm a price taker. The price maker is making two-way prices. If I have to buy euros, I have to deal on his offer price. Here, I have to buy dollar yen. I am a price taker. The price maker is making two-way prices. If I have to buy dollars, I have to deal on his offer price. So actually, the true synthetic is, as you guys correctly identified, I have to multiply now you see that there is no arbitrage. Now you can see, of course, I've taken extreme examples because I wanted to show you a big difference between bid and offer. In the real world, euro dollar bid and offer is not this wide. Okay, it is probably maybe just a pip wide or 1.5 pips wide. So it's 121 and 121 or 1/2. Very, very tight. So we can make it a little tighter. We can make it 1.2149, and we can make it 1.21. What is it? 10, 09, 11. Okay, very tight. 2 pip. More realistic. Much more realistic. 93, 6. Let's make it 103, 95. 2 pips. Okay. 95, 97. maybe even tighter than this in real life. Okay. Now you can see here, guys. Now you can see. Once you look at realistic bid and offer, it's actually the same. No arbitrage opportunity. These are fairly realistic. Okay. Can you see now what's going on? Whoever's the guys who are left. Okay. Yeah. Now you can see this. Okay.
Yes.
Yeah. So
That was also a part of my question earlier, but now I understand it more better. And sir, I was also thinking about the practical problems that might.
1 minute, Siddharth. Not more better. Better.
Yes, sir, better.
Yeah, can't say more better. Yeah. Okay. Yeah. Okay, I got it. Okay. So yeah. So this is I just wanted to make sure you understand to complete the whole discussion. I didn't want to hold back people, but for those who are interested in completing the learning, you have to go through the whole details of how do I execute the synthetic position, and therefore it's important to understand with the help of foreign exchange how to execute a synthetic long euro-yen position by trading in related markets like euro-dollar FX and dollar-yen. You didn't touch this market directly, but synthetic you created, and by looking at actual realistic bid and offer, you find the prices are the same. Yeah? Okay. Any other conceptual question? Then we'll move on to Sachin.
Yes, sir. Sir, this means that there are not only two transactions while executing is there are more than two, because the route we are taking for getting the synthetic, that will also factor in, and there would be more than two transactions, like one for direct and more than one for reaching the for the synthetic.
Correct, correct. Yeah, even this example that you can see, the synthetic requires two transactions, right? Here you can see the synthetic requires two transactions. In the example of the hot cup of tea I gave you, the synthetic requires hot water, it requires a tea bag, it requires milk sachet, and it requires a sugar sachet. So it requires 4 transactions. So it will vary depending on what you're trying to do. So yeah, in general, you can expect that the synthetic will require more than one transaction. If you remember, we looked at your long underlying. Synthetic equivalent of long underlying is long call plus short put, 2 transactions. So in general, you can expect more than one transaction on the synthetic side, but it need not be only 2. As you see here, it could be multiple.
Yes, sir. Yeah, practically it's not. It might not be possible to do this, but algorithms can maybe do it.
Yeah, so that's as I said, those who are in the arbitrage business, they are technologically set up in such a way that they are monitoring the prices. They have all their trading lines set up. And if they see a difference, they are ready to execute, but they are monitoring the market all the time and looking for these differences. And yeah, in general, you don't expect them, but if they happen, then you can trade on them. That's what it means to be in the arbitrage business. There are many people who are in this business, and that's all they do basically. They don't take any market risk. But they are ready. They understand that you don't get this opportunity several times a day, every day. And so you'll have to wait around and see if it comes up at some point. And that's a risk you take. You may invest in your technological infrastructure, and it's the same as opening a cafe. You may open a cafe in Rohini, and you put up some money, guarantee some rent for 6 months or 1 year. You buy your equipment, and then nobody shows up. But that's a risk you take in any business. You set up the infrastructure, and then you don't have any business. And nothing you do can ever change that. That uncertainty can never be removed from life. Right? So any other question, conceptual question, then we'll move on to Sachin.
No, thank you, sir.
Okay, fine. Yeah, so Sachin's lunch is also getting delayed. Yes, Sachin, your problem is being solved.
Yes, sir. Eventually, sir, a few days back, my